Hey everyone, this is Trading Price Action Trends Chapter 15. It's all about channels. It's a pretty long presentation just because I added a lot of examples. If you feel like it's too many, let me know for future chapters, but I don't think you can have too many examples just because that's what creates the pattern recognition to see it in the same thing in different ways. So I try to include as many as possible. If you do feel like it's too many, please let me know. So Al starts off the chapter by talking about what channels are, and that's when the trading that you see on your chart is mostly confined between a pair of lines. So you can have a trend channel that is tight or broad, and you can have it converging or expanding. So here we have a 5-minute spike in channel trend, but in this case, the channel is very tight. So the lines are close together, the slope is steep, and Al says that when the channel is very tight, it's actually a spike on a higher time frame. So here it's a spike in channel on the 5-minute, but you can see on the 30-minute, that same section is actually just 6 bull bars in a row with no break. So that's a spike of its own. So although it looks like a tight channel here, it's actually a spike on a higher time frame that should have its own channel. Now, tight channels tend to broaden out as they get weaker. So as the breaks get larger, so here we have a tight channel down, we get a break above the moving average, and then it broadens into a wedge and then reverses. So tight channels become broad channels before they become trading ranges and possible reversals. Here's another example of a spike and channel. So the broader that these channels get, the more likely there is two-sided trading. So when the channels are tight, it's a spike on a higher time frame. When the channels are broad, there's more likely to be traders on both sides of the channel. And you can also have converging channels. So this is a wedge. It's still a bull trend, it's still a bull channel, but it's a converging channel which makes a wedge. You can also have horizontal channels, which are called trading ranges. So if they're trending, they're called trend channels. If they're horizontal, they're called trading ranges. Al says that even if it's a little bit sloped, he prefers to call it a trend channel. Even though they're traded the same way, a broad trend channel and a trading range are traded in a similar way. But if it has some kind of direction to it, Al likes to call it a weak trend channel. And then within the section of trading ranges, you can have expanding channels. So this is within a horizontal channel, but you can see the price is expanding here. So that's also a type of horizontal channel, an expanding triangle. And you can also have converging lines, which is also a type of horizontal channel. In this case, it's a converging triangle. So where do bull channels occur? They can happen in trading ranges. And when they happen in trading ranges, Al says that it's best to buy near the bottom of the trading range. So if you look to the left, or if you look at your screen and most of the price action is sideways, you can assume it's a trading range, and you want to preferably buy in the lower half of the range. So even though in this case we have a bull channel within a trading range, you want to try to buy in the lower half of the bull channel and also in the lower half of the overall trading range. So in this case, we have 2 pushes up. We get a test back down to the trend line. This is buying low in the bull channel and also buying low in the overall trading range. So it's a reasonable buy. So here's another example. This looks like a possible spike in channel, but it's a lot of sideways price action. And so it looks like we're forming a breakout, pullback, second leg, pullback. So it's a type of bull channel. So ideally you want to buy at the trend line and not high in a bull channel, especially when there's a lot of sideways price action. The other area where bull channels can occur is in bull trends. And so Al says that when you have a bull channel and a bull trend, or when the market's clearly trending up, you can buy more indiscriminately in the bottom half of the channel. So when the channel is tight, we talked about this, that it's a possible spike on a higher time frame. But when the channel is tight, you'll have swing traders just holding, and you'll have bull scalpers buying every time it tests down to the bull trend line, or buying below bars, buying bear closes, because it's a tight channel. They know that even when this channel breaks, it's probably going to go higher because it's a spike on a higher time frame. But the idea of the channel is that when the market's trending, bulls will be more free to buy every time it tests that trend line. So here we have a major trend reversal, strong break above the moving average, and then a spike in channel trend. Once these trend channel lines start to be respected, bulls will start to buy at the moving average, at the trend line. But because this is a little bit broader and we have some bigger swings, you'll also get some bear scalpers at the highs, but that's a more advanced way to trade these. Finally, you can have bull channels in bear trends, and those are typically bear flags or final flags. So here we have a spike in channel in a bear trend, and this is a wedge channel. And so here we break it, we test the bottom of the channel, and then we get trend resumption down. Here we have another bull channel in a bear trend, probably a bear flag. We got a breakout, pull back to the moving average, and then trend resumption down. So Al says in these cases, traders should look to sell near the high of the bull channel or sell after a downside breakout pullback. So here, once we get that third push up, traders can start to sell because the context is bearish, or they'll wait for a break below the bull channel and then a retest of the channel and a successful test and then look to sell. So here we have bull channel as a bear flag. So one way is to sell high in the bull channel, which is sell breakouts above prior highs or wait for stop entry setups that fail to break out above prior highs. And so here we have a low 5 sell below 41, which is a credible sell. Or as Al says, you can wait for the breakout pullback. Or if it's a very strong breakout, like in this case, you have a breakout and follow through, a lot of bears will start selling after the surprise breakout and after the follow through bar. Now I also mentioned that bull channels and bear trends can be final flags. And that means that the market is trying to set up a bear flag, but it fails and quickly reverses up. So this is an attempted bull channel bear flag, but it fails and accelerates up. And so this is a bull breakout of a bull channel, which tends to happen in climaxes and trading ranges, and we're going to get to that in a bit. Here's another example. Bear climax tries to get multiple attempts down to form a bear flag, but it can't break below the channel. Eventually breaks above the moving average, holds, and accelerates up. Here's an example of a trading range, big up, big down, tries to form a bear flag near the bottom of the trading range, and instead gets the upside breakout. So I thought this was an interesting part of the chapter where Al talks about the unknowns. He says, we don't know that a channel is forming until we get that second push down and that it starts to hold. So here we have a spike, pullback, another leg up. We don't know if this is 2 legs up in a trading range for reversal or if this is going to form a spike in channel. So we don't know the channel is active until the first push up, second push up, and then the second push down starts to see buying pressure and that it's going to hold. Once that happens, then we're probably going to get a push up above this high for a spiking channel. So here's an example. We don't know if this is 2 legs up in a trading range for reversal down, or if this is going to be a spiking channel. So we have one push up, the second push up, which is the possible start of that channel, and then it doesn't hold here at the trend line. It just breaks straight through. So we have to be patient to see that the channel is forming and not just assume that it's going to form a channel all the time. Here's another example. Break below the channel, tight channel here. 2 legs up. Now, is this going to form a bull channel, or is it going to be a 2-legged pullback for a major trend reversal? And here we break strongly below the moving average, strongly below that possible trend line, and we get a full reversal. Now, that same scenario here, this could be a major trend reversal, 2 legs up and then reversal, but here we found support at the trend line. So once we get 2 pushes up, Al says that many traders will fade that second leg up. Because 2 legs up, if it's not in a bull trend, it could be 2 legs up in a trading range, which is very common before getting that reversal. So traders will sell the second leg. But once we get support at that trend line, and it proves that it's forming a bull channel, Al says once the bull channel is confirmed, we're probably going to get above that second push. So 1 push up, 2 pushes up, and then we get support here. Now it's a confirmed bull channel. So here again, we have sideways price action, 2 legs up, and now we hold that trend line. So when we hold the trend line, we're probably going to break above that second push and form 3 pushes up, because that's what typically is characteristic of a bull channel. Now it's important that Al says that bull channels have at least 3 pushes up, because in a bull trend, the market's constantly forming 3 push patterns, and they often extend much beyond that. So in a bull trend, even if there's 3 pushes, if the channel is tight or there isn't an obvious overshoot or good sell signal, it's better to only be looking to buy. So now once we get those 3 pushes up, traders will now look for a strong sell signal, overshoot, or a strong reversal down, and look to sell for a test at the bottom of the channel. Once we get that third push up, the odds increase that we're going to break through the trend line. So here's another example. First push up, second push up. Is that just a 2-legged bear flag for a strong second leg down from here? It could be, but here we found support at the trend line. So we have 2 legs down and then a good entry bar. So we're probably going to break above that second push, and then bears will look to short. And here it just continued into the end of the day, but then you can see we got a gap down on the next day. So that second leg started after a third and fourth push for the bulls. So it's important to see how it reacts at these lines and not just assume that 2 pushes up is going to lead to a break below or is going to lead to a channel. We have to see that the bulls are stepping in. So most of the examples I've shown so far have been in the context of a trading range the widest possible interpretation of the bull channel. So if it can't hold the widest possible interpretation, then it's probably not a bull channel. But another unknown that we have to be aware of is that once we get the spike and pullback, we don't know how steep or how strong the channel is going to be. So you could assume that this breakout here is the first leg of the channel phase. So spike, pullback, and then channel for 1, pullback, 2. And then we just form a broad channel and enter a trading range. But every breakout is a spike of its own, and it can be interpreted as a spike of its own. So here, is this just the first leg of 2 legs during the channel phase, or is this a new spike for a new channel? And so when drawing channels, you can't just draw a trend channel line above the swing highs and then drag it down and assume that the channel is only going to start if it comes down and tests that bottom line, because sometimes that new spike is going to have a channel of its own, and you'll miss all of these trades if you only wait for this red line to be tested. So it's important to reinterpret the chart based on what's happening. So if you see that after this breakout, it's not coming down to test the red line, but it's actually finding support, the moving average, and getting a new breakout, then maybe you have to readjust your lines and interpret this new breakout as a new spike in possible channel. So it's important to constantly be re-evaluating and reinterpreting every spike to see if it's going to have a channel of its own. We have a similar situation here in Microsoft. So this is the weekly chart of Microsoft. And so based on Al's initial recommendation, you see these 2 legs up. So 1, pullback, 2, and maybe you draw a trend channel line along the swing highs and then drag it down. And so you want to see the market hold at this line. Now it doesn't get quite down to that line and reverses up strongly from there. So it broke above the moving average, held at the moving average. Now we have a really strong surprise breakout and follow through. So if a trader is just waiting for it to test this red line to confirm the channel, then they might miss this whole rally. And so a trader has to be aware that this is a possible higher low major trend reversal. And so this is possibly a new spike for a new channel. And then they would have to readjust the channel based on the pullbacks that they see. So it looks like this is a more accurate interpretation of a new spiking channel. And so you don't necessarily have to wait for this to be tested. If the market starts to find support at higher levels, then it might be forming a new spiking channel, and you have to be aware of that. In the context of 3 push patterns, Al also talks about the vacuum effect. And so often the third push is strong. And so here you could consider this as the first push, 1, 2, and 3, and it looks like it's starting a new trend. But Al says that that third push is often strong because bears know that we're going to get a test of the trend line. So because they know it, they're waiting to sell higher, and that's what creates this vacuum effect. So here's another example. These are lines that give the best interpretation of this price action. And we have 2 pushes down. In the third push, bulls are waiting, weak bulls are exiting, and that's what causes the overshoot. But even though this looks strong, it's a third push down in a bear channel. And so a lot of strong bulls are waiting for this to happen, for an overshoot, and then they'll start to buy and reverse the market. So these third pushes can be strong. And so unless they're extremely surprising and they change the character of the market, they can often just be vacuum tests of the trend channel line or create overshoots and then lead to a reversal. So it's important to be aware that just because it's strong doesn't mean that it's changing the character of the market. It could just be a vacuum. Now we're going to move on to the bulk of the section, which is how to trade channels. So when it comes to trading channels, there are 2 types and 3 phases, and that's what's described in this chapter. The 2 types of channels are tight channels and broad channels. We talked about that briefly at the beginning of the chapter. Now, it's not binary. It's not just tight or broad. It's a spectrum. So channels get broader based on how large the swings are, how deep the pullbacks are, how wide the trend lines are apart, the trend line and the trend channel line. So it's a spectrum, and it's based on how easy it is for the opposite side to make money. So if the swings are large and it's easy for the opposite side to make money, the channel is probably a little bit broader, and you can change the way you trade it. So are you going to trade it with stop orders if it's a very broad channel, or is it only appropriate to trade with limit orders if it's a tighter channel? And so within the channel, there are 3 phases. There's channel initiation, which is when do we expect a channel to start? We have a spike, we're expecting a channel, so what are we looking for to see if that channel is starting, and how do we trade it? Then you have the established channel. Once the channel is established, how do we trade it? And then finally, once the channel breaks, what should we do? So channel initiation. For spiking channels, once you see a spike, the probabilities are that you're going to get a channel. And so a spike can be multiple strong bars up, or it can be a very tight channel up. Those can often act as spikes. Most bulls should look for a high 2 stop entry buy or some kind of bull flag buy. So here, for example, we have a tight channel up. Al says this is a parabolic wedge, it's 3 pushes up, but it's in such a tight channel that it's going to act like a spike. And so where will bulls buy? So most bulls should look for a high 2 buy once it's established clearly always in long. So Al says there are multiple areas here where this switched to always in long, but an obvious one and the latest one for the most conservative bulls is when it broke above bar 18, because we had 2 legs down. It's a break of a triangle after a spike and probably the start of a channel. So most bulls should wait for this high 2 buy at the moving average after the spike and look to buy above 18. So just for reference here, I'm going to be showing credible stop entries with green arrows, and then credible limit orders with orange arrows, and then red arrows for situations where it's better to wait or better to skip. Here's another example. We have a major trend reversal, spike up, and then we have a high 2 buy right above here where the green arrow is. That's a buy expecting some kind of channel after a spike. Here's another example, gap up, spike up, high 2 buy right above the moving average, expecting some kind of channel up. Now, experienced bulls will trade with limit orders. And the way that they'll trade with limit orders is for looking for an end of structure or bad low 1s and bad low 2s, which are bad sell signals. So they're going to bet that the bear breakouts will fail. So here, for example, this is a bad low 1. Al explains that it's a tight channel up and we have a breakout in an inside bar. Bears are probably not going to get a swing down because we're still always in long. So bulls will bet that the bear breakout will fail below the inside bar and they'll buy that low. And that's also what I call a possible end of structure, and I'll explain that in a second. So here's another example. We have a spike up, and then we have a low 1. So we have a bear breakout and then an inside bar, doji inside bar. Bulls will bet that the bear breakout will fail and that bears who sell that will lose money. So we should go above that inside bar. And so they'll buy there, they'll buy more lower, betting that they'll at least get a scalp because we're still always in long and still probably going to test the 3 high, at least. So I mentioned end of structure. I'm going to explain that here. I found that thinking about it as a possible end of structure is a good way to understand what Al means when he buys bad low 1s. So the basic leg structure is we have an impulse, a pullback, and when the pullback is strong, we can either get a higher low test or a lower low test before a major trend reversal or some kind of trading range, right? So that's the basic structure. You have impulse, break of the moving average, and then one more extreme test. This whole thing looks like this: bear breakout, bull bar. So on the lower time frame, it's maybe this is a 5-minute chart. On the 1-minute chart, it's 5 bull bars up. If this is a 10-minute chart, on the 1-minute chart, it's 10 bars down and then 10 1-minute bars up. So it's possibly breaking above the moving average on the 1-minute chart, breaking above a trend line. And now we're going to get an extreme test. So it's either going to be a lower low, which is this dotted bar here, or it's going to be a higher low test. When Al buys below a low 1, he's saying that it's a possible end of structure. So it's a breakout, a test of the moving average, and then a possible higher low major trend reversal or lower low major trend reversal. So he buys that bear breakout, betting that once that structure is complete, it could mean that the pullback is complete, and now we're going to start to rally. So you're essentially fading a breakout of a possible final flag, and it's a major trend reversal on a lower time frame. And this is common after a surprise leg. So now if we look at this again, it's a surprise bar, a pullback, and then now is this going to be a higher low major trend reversal on a lower time frame? Is it going to be a lower low major trend reversal? We don't know that, but Al talks about how bulls will fade this, betting that this is a possible end of structure, end of the pullback for the start of the channel, or at least just a bounce, because sometimes major trend reversals lead to trading ranges. So we don't know if it's going to reverse the entire thing, but it's a reasonable area to bet on the end of structure and that we're going to get at least a scalp for the bulls. So here's the same thing. It's a bear bar and then a break up. So it's a possible end of structure, and bulls will buy that low and more lower. In this case, this ended up being a lower low major trend reversal on a lower time frame. So it was a bear bar, break, and then a larger second leg down. So it's actually a leg 1, leg 2, but that led to a trading range. And so bulls who bought there and bought more lower were able to make money. Here's another example. So we have 4 bars down, then an inside bar, and then a low 1 at the moving average. So right now we're always in long, and this spike is probably going to lead to some kind of second leg or channel. So bulls are going to bet that this bear breakout below this flag is going to fail. And so they're betting on a possible end of structure. So they'll buy that low. And here we got a scalp, and got a swing out of it if they held for the channel. Same situation here, surprise bar, pullback, bulls buy below that low because they're fading this flag. So it's a possible end of structure. And then that just goes on and on. There's so many examples of this, and I think that's one of the most useful ways to understand these concepts is to find all these examples and see that it just constantly repeats itself. You get a spike. Here we got one leg down here, so one, and then two-legged pullback, second leg down for a double bottom bull flag. And this ended with a possible end of structure. So we have a surprise bar, doji, and then bulls buy below the doji, which is a flag on a lower time frame, betting that this structure will complete. Same thing here, spike, 2 bars down. Here we got an outside bar, which is the same concept. It's a flag on a lower time frame after an impulse down, possible end of structure, bulls buy below the doji. Here as well, 1 leg down, 2 legs down. This leg is a surprise. You get a very deep pullback, bulls buy below that low, looking for at least a scalp, betting that the bear breakout will fail. Now sometimes we don't know if the channel is going to start right away or if it's going to need 2 larger legs down. So here we needed 2 larger legs down. Here we had 2 legs down. Here we only had 1 leg down. Here we had 1 leg down and then a small leg down. In Al's example, we had 1 leg down, 2-legged pullback up, and then a larger second leg down. So we don't know if it's going to be a 1-legged pullback or 2-legged, but the odds are that we're going to get some kind of second leg or channel. And so bulls will fade these bear breakouts, betting that a channel is coming. Now, part of the channel initiation is these bad low 1s and bad low 2s. So along with that initial pullback and end of structure, bulls are also fading other low 1s and low 2s in that initial stage of the channel where it's not completely established yet. You might not be able to draw perfect trend lines yet, but we know that a channel is probably coming. And if the bears don't do enough, then bulls will keep fading those bear breakouts. So here we have that first initial end of structure buy, and then we have a second leg down and then 3 bull bars and a bad sell. So bulls will buy that and buy more lower. That's technically a low 2 sell for the bears. Or if you just look at this 3 bull bar breakout as a new breakout for the bulls, it's the first sell for the bears, which will probably fail after 3 bull bars in a possible tight channel. So here Al says the initial buy below this inside bar, and then we get a strong bar here, this bull bar, and then this becomes a sell for the bears. So it's a bad low 1 again. So Al says bulls will buy that because we're probably going to test the 3 high. So bulls buy this bad low 1. They don't buy this one, and Al talks about why they don't, because now we have 2 legs up, tested the 3 high, and we have a 2 bar reversal. So this is actually a good low 2. And we have another example of that right here. So here we have the end of structure, low 1 buy, and then we have a low 2. Now we don't know if this is going to lead to a channel all the way up here, starting from this bull bar, or if we need a larger second leg down. So once we get 2 legs up and then a good sell signal, this actually isn't a good fade for a bad low 2 because it's a possible test of the low of the trading range. So bulls will wait and look to fade breakouts below this and wait for the 2 legs down to finish. So that's an example of what Al shows here, that this is actually not a buy because it's a good low 2. Then we're still betting on a channel. So bulls will see that this break below the neckline is probably going to fail because we still have to probably get a channel. So they're going to buy below 4. They're going to buy once we get 3 bars up here, betting that this is going to be a bad breakout sell for the bears. They're going to buy this because it's a low 2 above the moving average, betting that a channel is going to start. So there are a lot of entries. It's not comprehensive. It's not all the entries possible. It's just the ones that Al talks about in the book and the reasoning behind it. So this is a pretty close example to what Al shows. We have the first end of structure buy, then we have a bull bar and a smaller bear bar for the low 1 sell for the bears, probably buyers below there. Here's the exact same thing. We have an end of structure buy here, strong bull bar, that becomes a new low 1 sell for the bears, but we're always in long and probably going to start a channel, so bulls fade that bear breakout, and there's buyers below there. Here we have the end of structure buy, and then we have a low 2 buy. So we fade the low 2 because it's probably a channel and not a low 2 for a strong second leg down. Now it could be, but it's probably not. Probably the strength of this is probably going to get another leg up, which we do get. I think a useful thing to remember here is that a low 2 sell for the bears is also a breakout pullback for the bulls. And so in this kind of situation where a channel is likely, it's more likely to act like a breakout pullback rather than a second entry sell for the bears. This situation too, below 11, it's a low 2 sell for the bears, but it's a breakout above the moving average and a pullback to the moving average for the bulls. So low 2, but also breakout pullback. And in this case, more likely to act like a breakout pullback. So here, end of structure buy below the doji, and then strong bull bar. This now becomes a low 1 sell for the bears. Exact same as what Al showed here and the example we had here. So bulls fade the low 1, bulls fade the low 2, end up getting a strong breakout for a channel. And here's a bear case. So spike down, pull back. So we have a strong breakout, inside bar. Bears fade that, betting it's a possible end of structure for a start of a channel. So they can scalp it or swing it. But that's the concept of why they're fading that inside bar. So that's channel initiation before the channel is clearly started. And now we're going to talk about what traders should do within the channel. So once it becomes established. So beginners, Al says, should only trade with the trend during a channel. So they'll buy bull flags that initiate the channel, which we talked about. They'll buy high 2s at the trend line. They'll buy high 2s at the moving average when there's at least one more push-up likely. Advanced traders during bull channels will buy bull flags that initiate the channel, which we talked about. They'll buy with limit orders early in the channel. They'll buy high 2s with stops or with limit orders at the trend line. They'll buy high 2s or with limit orders at the moving average when one more push-up is likely. So the difference between advanced traders and beginners is that advanced traders are going to use more limit orders at specific areas. So once we have this tight channel established, we talked about these buys already. Bulls will continue to buy at the moving average and at the trend line, and they'll fade bear breakouts. So here we have 2 legs down, so bulls will fade that second leg down at the moving average at the trend line, betting that the bear breakouts will fail until we get significant selling pressure. So we need to break below the tight channel and then a test back up. Until we get that, bulls will feel pretty comfortable buying at the trend line and moving average. And in this case, this is a limit order buy. So here we talked about all these buys. Bull scalpers will stop buying after 3 pushes up. And once we get a tight channel like this, they still think that the first break of this tight channel will lead to one more push up. So even after the first break of that tight channel, we know the channel phase usually has at least 2 clear pushes up. So that channel phase should have 2 pushes, which creates a larger 3 push pattern. So bulls are still looking to buy during this pullback, betting on one more push up in this channel phase. And so once we get that high 2 buy, bulls will buy with stops or with limit orders once we get 3 bull bars, betting on at least a small second leg from that. So there are a lot of ways to enter, but the important thing is to understand what's happening in the channel so that traders can make decisions about what the expectation of legs is. And so here, when this pullback comes to the moving average, the odds are we're getting one more push up in this channel phase for a larger 3 push pattern. So even though in this section we're talking about entries within channels, you could argue that this is a tight channel up and we're actually trading a breakout of a tight channel. And so this is an entry after a breakout of a tight channel. I'm including it in the section within channels because the expected channel after a spike like this is to get 2 clear pushes up. So even though it's a break of this tight channel, it's still within the expected channel from this spike. So I would still consider this buy as a within channel buy because it's happening within the channel that you'd expect after a spike like this. So we expect 2 larger pushes up. So I'm still considering this to be a stop entry within the channel. So here we have 2 legs down, strong breakout above the moving average. This is the first sell after a surprise breakout for the bulls. So probably buyers below there. So bulls buy with limit orders, or most bulls wait for a high 1 buy or wait to buy above the bull flag. So here is more limit order trading. Bulls buy all of these. We talked about these. And then they get a surprise breakout and they buy below the doji, bad sell signal after a strong surprise breakout. So this has more limit order trading, not as clear for most bulls who are going to use stop orders. Now the reason that Al mentioned that most traders should not use limit orders is because of situations like this. So here we have the 2 legs down and then we have the breakout and bad sell. So a lot of bulls will try to buy below there or buy the close. But then now we have 5 bars up. And so technically, limit order bulls will fade that sell because we should get 2 legs up if it's a bull channel. Some aggressive bulls will take the chance that this is a strong leg up and it should get a second leg, or it should at least go sideways. So limit order bulls need to have a very good understanding of context and need to use the correct stop and be willing to scale in most cases. So especially in a channel when pullbacks are deep, Al says that traders cannot get stopped out halfway through the channel. So they have to put the stop in the correct spot. And if a bull buys there, then they're going to wait for a lower entry to add more. So here we have that surprise bar, bull bar, and bulls will fade that, betting on the end of structure. So if they buy this low and more lower, this bar tested right up to that doji. So they were able to get out, break even on the first entry with a profit on the second. In this case, we did form a broad channel and get 2 more pushes up. So that is the expectation. We don't know if we're going to get it, but limit order traders can fade bear breakouts betting that we're going to get it. But then they have to be able to manage the trade correctly. And so here we have impulse, so the spike, pullback, tight channel. Bulls know that even after this tight channel breaks, we're probably going to get one more leg up at least for 2 pushes in the channel phase for a larger 3-push pattern. So some people will interpret this as spike, pullback, channel, and just this as a channel, but this is too tight, and it's reasonable to expect that even when this breaks, we're going to get one more push up. So limit order traders will fade this inside bar at the moving average, betting on a parabolic wedge to the moving average, and bulls will wait for a signal bar to buy above, betting on one more push up to break above this top. So in many cases in these situations, when you have the spike, pullback, and tight channel, when this breaks, we often won't have a trend line to support it to buy here. But the concept is that once the tight channel breaks, we should get one more push up, and so bulls will look to buy at the moving average. So here's another example where Al mentions that bulls will buy. We don't actually have this trend line yet. This trend line, this lower trend line, was drawn with 16. So we don't have that yet. But what we do have is a break of a tight channel with the expectation of one more push up. So once we get to the moving average with 2 legs down, bulls will start to buy. So you don't necessarily need the trend line there, but you need the understanding and the expectation of one more leg up. And so once we have that, you can look to buy at the moving average. So here's another example. In this case, you can draw the trend channel line, drag up the parallel, and see it's a potential failed breakout of the trend line. But it's also spike, pullback, first push down in a tight channel, probably going to break up and get one more push down. So bears can look to sell low 2s at the moving average. And here's another example in the channel. Within the channel, we have a high 2 buy for bulls to buy above strong bull bars at the bottom of the channel, looking for a test up above that last top and potentially the top of the bull channel. So here's an example of a bull channel and a bull trend. Once the trend line is established, bulls will look to buy in the bottom half of the channel, and they'll be pretty comfortable buying in the bottom half because we're in a bull trend. We're probably going to continue higher. And so they'll look for entries near the bottom of the channel there. Look for high 2 buys, look for bull flags, betting that will test above the highs and near the top of the channel. So this is the NASDAQ daily chart. Now we're going to talk about trading counter trend within the channel. So when the channel is very tight, if it looks something like this, Al says only buy. So this is a micro channel, but it's very tight, only bull bars. Traders should just be looking to buy. But there are times when the channel is not so tight, it's not very strong, where aggressive bears will trade counter trend. So they'll fade swing highs in a bull channel. And this is when the bars are not too big, there are tails, there's opposite trend bars. Al uses this as an example. So he says, yes, it's the start of a channel, but we're getting bear bars, we're getting small bars, we're getting tails. So bulls will bet on a channel, which has some trading range price action, and they'll sell bull closes above swing highs. So they'll sell this bar and sell more higher, and then scalp out at the original entry. Then we have this big bull bar breaking above the swing high. They'll sell that close. They'll sell the close of small bars after it. A good way to do this, that Al explains, is to wait for the bull breakout. So you wait for the bar to close or to get above the swing high and see how it acts, and then sell. That way you don't get caught in a surprise. So in this case, for example, if you wait for that bull breakout above the swing high, you see that it's a surprise bar, and maybe you wait for a couple legs up. In this case, it works anyways if you sell the close in more higher. But by waiting for the bar to close, you see what kind of breakout it is. And then you can judge, traders can judge how strong it is and decide if they want to fade it or not. So here Al says, we have bear bars, small bars, some two-sided trading. So bears will sell that close of 12. Sell that close, sell more higher if they can, and look for a scalp. Bears will sell this close right before 17. It's a bull bar closing above the swing high, but it's not very strong. It's a third push up. So bears will sell that close. Same situation here. So spike and channel, we're getting some two-sided trading. So bears will sell that bull close, they'll sell that bull close, they'll sell that one. all the ones that are closing above swing highs, but they're not showing a surprise breakout. And the character of the rally up to that swing high is not extremely strong. In this case, it's extremely strong. So Al's saying, don't look to fade bull bars above the swing highs. It's coming up with too much momentum. And he says the same thing about this one, that some traders will sell 30, but because of how it's coming up, some traders will wait because of the strength of that rally. And here's another example. Clearly two-sided, lots of bear bars. So every time we get a bull bar closing above a swing high, bears will sell that close, and they'll make money betting on deeper pullbacks and gaps closing. When the channel's broad, advanced traders will trade with limit orders and stops in both directions. So I think this is where beginners start to enter into the fading arena, where they can also fade channels, because the channels are so broad that it becomes okay to trade in both directions. But Al still says that beginners should only trade in the direction of the channel. But in this case, the channels are so broad that there's clear two-sided trading. And when it gets so broad and so flat, it acts more like a trading range. And traders can buy low, sell high, and scalp. So here, really broad channel, big swings, traders are buying and selling in both directions. And finally, the third phase is after the first break. So now we're going to talk about channel breakouts. So Al explains that you should interpret every bull channel as if it's a bear flag and every bear channel as if it's a bull flag. So whether the channel is tight or broad, eventually the breakout is usually beyond the trend line. So in this case, we have a broad channel. It's usually going to eventually break out past the bear trend line, even if it has some overshoots beyond the trend channel line first. So here is a tight bull channel. The eventual breakout is usually through the trend line. So in this case, through the bull trend line. Really tight channel here. Still, the eventual breakout is through the trend line. In this case, we have a really tight bull channel, and we have some overshoots along the way. The overshoot brings it back to the trend line. The test is successful, and we continue in that bull channel, and eventually we break to the downside. So in most cases, Al says 75% of cases, the eventual breakout will be through the trend line. In the bull channel, it'll be through the bull trend line, and so it'll be a bear breakout. And in a bear channel, it'll be a bull breakout through the bear trend line. A breakout of a channel will often test the start of the channel. I put a star here because during a larger channel, there are multiple smaller legs and channels. And so it's important not to get trapped by situations like this, which I did. On this day, I sold below 48, which is the lowest possible place to sell. And it was slightly impulsive, but also came from a lack of understanding of what was actually happening here in the context. So yes, it was a spike in channel, and I had this drawn, but a spike in channel does not mean that as soon as we fall below this trend line of the spike in channel, it's going to fall down to the start of the channel. There has to be a progression, and there has to be evidence of enough selling pressure to justify that. And so a bull channel, even if it's a bull wedge and a spike in channel, it's still a bull trend. It's still above the moving average. And so there has to be a protocol that's followed that Al talks about, which I'll get to. But it's important to understand that we're not just going to collapse into the bottom of the channel. There has to be some kind of progression and an accumulation of selling pressure before that happens. So here we have the spike, 2 more pushes up for a 3-push pattern. That breaks, but that creates the first moving average gap bar. So that's still a buy for the bulls. It's not a sell looking for a test of the bottom of the channel. It's a tight channel up. It still has not broken the moving average. So this is still the first break of this channel is still a buy. Now in this case, although this is a spike in channel, this is also a spike, pullback, and then tight channel. And so we don't know if we're breaking this full channel for a test at the bottom of the overall channel, or if it's just if this is just breaking this channel to test the bottom of this channel here to form a double bottom bull flag and then a larger second leg up. So in this case, it's actually spike, pullback, and then one big leg, break, and then a second big leg. Both of these legs are subdivided into 2 legs. So it's 1 pullback, 2 pullback, 3, and leg 2 and leg 3 have 2 small legs in them. And that's actually quite common. So here we have a spike, pullback, channel. This channel is tight. It breaks that channel, but then this whole thing acts as a leg on its own. So again, it becomes 1 pullback, 2 pullback, 3. So when we break this channel, it does not mean that we're going to fall back to the bottom of the channel. It just means that this leg is now broken, and now the bulls and bears are going to decide what happens next. And if the channel is tight, it usually pulls back to the moving average and gets one more leg up. So here's another example. We have a spike, pullback, channel, and one pullback, two breaks, and instead just goes sideways. And so bulls will buy. I'm pretty sure Al bought above bar 52, which is right here on this day, because it's still a bull trend. It's still barely getting through the moving average. So bulls are still looking to buy. And in this case, we got one pullback, two pullback, three. So this whole trend line that broke, even though it was a possible three push pattern, it was so tight and didn't have much selling pressure. And so that first break just went sideways, and bulls bought it up again, betting on one more leg up. And so we got that leg and eventually broke below the moving average. Now within a channel, there are often multiple legs and channels. And so here we actually have a spike and channel, but then within that, we have a spike and channel, which is what I mentioned here as well. So this is also could be interpreted as a spike, pullback, channel. And here is a little bit more obvious right here that this is a spike and then its own channel. So this channel broke. Now what often happens is that when you have smaller channels within a broader channel, the overall broad channel is still in the process of forming. And so like I mentioned, like here, when we get a break here, it's not necessarily going to come and test this low because the overall broad channel might still be forming. And in this case, it was. So if you drew from the trend channel line from this high to this high, including this high, and you drag it down to the bottom, this is actually part of a larger channel. So just because we break this channel here, doesn't mean that we're breaking the overall broad channel. This is still actually in the process of forming. And so we may not test the yellow line here until this entire broad channel breaks. And if I go up to the 15-minute chart, that whole day here is in this white box. And you can see that the channel was respected for a couple days after, that new channel that was forming, that broad channel. And it took a little bit of redrawing on the top, but for the most part, the bottom trend line holds until we get the overshoot here, a second leg up, and then a break. And then we get down to the bottom of the channel. So once the overall broad channel has formed, usually it's the widest possible interpretation. So here, we could have drawn the channel this way with these white lines, but if you look at the widest possible interpretation, which is this one, that might still be in the process of forming. When that one breaks, then the odds increase significantly that we're going to test the bottom of the channel. But it's important to not assume that the complete channel is broken and that we're going to race down to the bottom of the channel without seeing the progression of the legs and how the actual full broad channel progresses. So that's why in the chapter 13 and 14 summary, I said that the first test would be to see what we do at the test of the break-even stops for the second entry bears. So the bears who sold the second entry sell here. When this spike in channel broke, because it's a tight spike in channel and we haven't broken above the moving average yet, the first objective is to see if we're actually forming a broader channel. And so if you take the trend channel line here that's drawn from these two swing lows and drag it up to the 11 high, you want to see how it acts there. So you can either use the 11 high here, or you can even drag it up to the 1 high and see how that acts. That's less important than understanding that once we break out of a tight spike in channel, the first interpretation should be double top bear flag and then trend resumption down for a test of the extreme. So the double top bear flag is the highest probability. And then once we test the extreme, and if we get a major trend reversal attempt, then a lot of bulls will look for it as a major trend reversal. But in this case, when we tested the extreme, it was in a very tight channel and we didn't even go up. We didn't even trigger above a bull bar. So even a bull who's waiting for a stop entry buy didn't get it here. And then eventually we got the overshoot. And then the next day we broke back into the channel and tested the trend line, which is what you'd expect after an overshoot of a bear channel. Now in this case, the trend lines are all the same. So the only trend line you can draw here is this one, and that's the broadest possible channel. So when that one breaks and holds above the moving average, it increases the likelihood that we're going to test the top of the channel and get a rally from it, because there is no possible broader channel. This is the broadest possible one. And so Al says that the widest possible channel gives you the highest possible probability. So here's one more example of the same concept: spike, pullback, channel with two pushes, but this is also a spike in channel. And so when we break this trend line, are we breaking the full channel, this entire broad channel, or are we just breaking this spike in channel? And in this case, we broke this, we tested down here to the bottom of this channel, formed a broader channel, tested up for a higher high major trend reversal and then got the breakdown, and then eventually tested the bottom of the channel and got even lower than that. So this is what I mean by getting the expectation for the full broad channel and then seeing how it acts. So usually when the channel is tight, it often does get down to the low of the last push. So here we had spike, pullback, 2 legs up. We broke it. We come down and test the higher low here. We don't come all the way down to the channel, but we often do test the higher low. Here we didn't get all the way down, but we got close to it. Here we came down to the low of that second leg. So spike, pullback, 2 pushes up. We come back, test the higher low, get a possible major trend reversal attempt, and then we break the broader channel. So as long as the channel is tight here, bulls should still be expecting a moving average gap bar buy and not expect a major trend reversal. So here's a 3-month chart of TD. It's a spike, pullback, channel. So we have one pullback 2 here, that breaks, comes down to the moving average, gets another leg up. Then even that is spike, pullback, 1, pullback 2. So that's a larger 3-push pattern. But even that finds support at the broader channel. So before we can get a test of the low of this channel, we're still forming the broad channel. Now we have an overshoot. And so based on Al's rules, even if we get one more leg up here, we should go sideways to down to test the trend line. But we're still in the process of forming this broad channel. And so all these trend line breaks in the meantime are not necessarily reversals. They're just signs of possibly a deeper pullback or sideways before a trend resumption. So in a bull trend, we should always be assuming trend resumption after a pullback until there's a climactic reversal or some sign of selling pressure that warrants it. Now, even with overshoots, a broader channel is often forming. So here we have a larger channel. We have a possible convergence for a wedge, but we break below it. That break below is actually just confirming a larger channel, a larger, broader channel. And here as well, this is actually how Al drew his channel on the end of day review for this day. If you watch the old webinars, this is January 19th, 2016. So we have a large channel here. We have a wedge, so it's trying to bottom, but the bottom fails, and we get 2 legs down. Those 2 legs down are not necessarily acceleration into a bear trend. They're possibly just forming that broader channel, and it finds support and overshoots that trend channel. If you drag this down to this low, it's actually just forming a larger channel, and then we get that reversal up. So now that we've talked about breakouts of channels in general, we're going to talk about how to trade breakouts below tight bull channels. So we mentioned that a tight bull channel is a spike on a higher time frame. It often is. And so that first break below a tight bull channel will usually fail, and Al says that it often reaches a measured move of the breakout. Now, this is going to be dependent on the leg count. It's going to be dependent on the context. But the main takeaway is that the first breakout of a tight bull channel is not something that traders should look to sell aggressively. So it's probably going to become a pullback that will reach a measured move up. So it's a spike, and if you look at the pullback on the 30-minute time frame, it's really small. It doesn't seem like like it would be unusual or uncharacteristic for this to get a measured move up. And so here, when you get the first pullback from the tight channel, it's not far-fetched to expect a measured move up. Here again, we have a spike, tight channel, break. This is not a very strong breakout of the entire trend because it hasn't even touched the moving average yet. But it is a 2-bar breakout of this tight channel. And instead, we find buyers. And we get a small second leg down here, but eventually we get the breakout and get approximately a measured move up. We don't get quite to that target, but we get in that approximate area. And then here as well, we have a spike, tight channel. We get a breakout. It's a pretty weak breakout. It's 2 legs down to the moving average. And here we get an exact measured move up from this breakout. So that first breakout should not be sold, even if it's strong. Bulls should be looking to buy it with a good stop entry buy at the moving average, looking for a test of the extreme at the very least. And if the context is supportive, a measured move up. So most traders should wait for with trend stop entries after failed breakouts below the tight channel. So we talked about high 2s at the moving average or trend line within the channel, but now we're talking about bull flags at the moving average after the first trend line break. So we're looking for a measured move up, or we're looking for a lower high or higher high test of the extreme at a minimum. So here's the example I've been showing, tight channel, 2 legs down for a moving average gap bar, bulls buy the breakout, looking for a swing. And here, same example, breakout below the tight channel, bulls buy a high 2, looking for a swing. They may exit below this. It's a possible low 2 sell. So some bulls will exit depending on the stop placement. So that depends on individual management. Now here's a bear case, tight channel, break above the tight channel. Once we break above the tight channel, bears in this case are still looking to sell because that first break of the tight channel will usually fail. And here we get 2 legs up to the moving average and a low to sell. So bears will sell that for a swing, for at least a test of the extreme. And here we got much more than that. We got a measured move down. So here's another example. Now these channels are getting broader and broader with these examples I'm showing. And so as the channel gets broader, traders who are trading with trend are going to be more and more likely to be aggressive on the exit at the test of the extreme. So here we still get the low to sell for a test of the extreme, but the bars are weak. And because the channel is getting broader here, traders will become more aggressive. Now, we also don't want to fall into the trap of hindsight. So maybe you do wait for a second entry buy to exit and you don't get it, and instead you get the strong bull breakout. In that case, you have to exit on the bull breakout. And I'm going to talk about that in a bit when I talk about major trend reversals. So here we have a bear channel. It's kind of broad. The gaps are closing. We're getting good buying pressure. So here we wait for 2 legs up. Sorry, these arrows are for later on, so I'm going to delete them right now. So tight channel up. You can either sell that for a parabolic wedge, bear flag, or wait for 2 legs up and then sell. But after that break of the channel, bears will still be looking to sell that first break because this is a moving average gap bar sell, and they'll look for a test of the extreme. So again, here you got a lower low test of the extreme, and some traders will exit when it starts to hesitate because the channel is already broad and a trading range might be more likely. Some will wait for their own exit criteria. That depends on individual management. And here as well, we have a channel. It's kind of broad, but it's still a bear trend. And so we get that first break of the trend line and the moving average. It should still get a test of the extreme. It's a moving average gap bar sell, and traders sell that low 2 looking for a test of the extreme. Now here again, if you don't have management criteria that gets you to exit here, you'd have to exit on that re-break of the moving average because that's a possible major trend reversal. Now, the next thing that most traders should wait for is a strong break and extreme retest. So we talked about how trend traders are going to look for a strong break and trade with trend, looking for a test of the extreme. The rule for Al is that you should only be trading counter trend once you get that strong breakout and a test of the extreme that looks weak. So traders will study the rally after the breakout to look for a breakout pullback sell, major trend reversal. So now we're going to talk about the strong break and extreme retest. So this is kind of a reminder to myself, but also something that I think a lot of traders struggle with, and that's to not sell low on the first break, even if it's strong. So when you have a tight channel, that first break is just a bull flag. And so here we have a spike in channel and this strong 2-bar breakout. It should not be sold low, especially with limit orders. Unless there's some kind of context that's supportive, and that the contextual reads take longer, take a lot more experience. Most traders, that's why Al says most traders should not be looking to sell low and expect that this is a 2-bar breakout that's now going to end up down here. This is a break of a tight channel and usually fails. So experienced traders will actually wait for this bear breakout to fail and then look to buy that first break. So here we have a 5-bar microchannel. We break strongly back above it because that's what's expected. And then bulls actually buy the retest. So they're buying where those bear microchannel sellers are selling and exiting. Because they know that the context after a spike and channel with a really tight channel is that the first bear breakout should fail. So here as well, spike, tight channel, bear breakout, 4-bar microchannel, but then we get 4-bar microchannel up and the context is bullish. So some bulls will actually buy that first break. They'll put a limit order where those microchannel bears will be exiting and look to buy for another leg up. And here's another example. So tight channel up, first 3-bar breakout, it's strong, but bears should not be selling that close expecting for a collapse. This is still the first break of a tight channel, and many bulls will wait for that rally up and buy where those microchannel bears are exiting and look for a scalp. So once you get the first break, now traders will study the rally, and if the rally is very strong, then trend resumption is more likely. So here we have the tight channel breakout, and we get a 3-bar strong breakout. At this point, we're not looking for a major trend reversal anymore. We're looking for trend resumption because of how strong this is. So bulls are going to look for a reason to buy, looking for trend resumption. So here again, tight channel down, first break, and now traders will study this test of the extreme. In this case, the break isn't even that strong, and so trend reversal traders will be less likely to look for a buy here. But even if they are, this is a pretty strong sell-off. There's not much buying pressure. So that will negate the amount of bulls that are looking to buy a major trend reversal, and it increases the likelihood of at least a second leg down, which we got. So one important thing that Al mentions here is that even if the rally is strong on the test of the extreme, if it's strong but late in an overall structure, then trend traders will take profits on the test of the extreme. So instead of assuming that it's now going to become a channel or a trend resumption, because it's late in a trend or late in a structure, they'll instead look to take profits after a strong break of the moving average. So they're not exiting on the break of the moving average thinking that that's going to lead to a collapse. Trend traders are seeing this tight channel, they're seeing this strong break, but they know that that means that we're now going to test the extreme, and they're going to look to exit on the test of the extreme. So they're not panicking out. They still know that this breakout of a tight channel is probably going to fail at first, and then we're still going to test the extreme. So Al says that they see the break to 4, and once they see that, because it's now the third push up, even though this is strong in a tight channel, it's a third push, and they'll look to exit on the test of the extreme. So Al says a tight channel is a spike, but it's also a climax, depending on the context. And in this case, it's a third push up, and that can lead to a larger pullback, which we got. But even after this break, this whole channel is tight enough that even after the break, bulls are still looking to buy for trend resumption up. So here's another example. We have a tight channel break, led to resumption. Tight channel break, led to a test up. But because of the 3-bar breakout and the third push up, even though this is strong, traders will look to exit on the test of the extreme. And you can see that there were sellers above here for a 2-legged correction down to the moving average. That still led to trend resumption up eventually. But because of the tight channel breakdown on the third push, traders will take profits here. Here's another example. Tight channel. We get the first break of the tight channel. Now this had a lot of buying pressure earlier in the day, so it could be a trending trading range day. It could be a doji day. It could test the open of the day. So there are a lot of reasons why this might bounce. But here traders still don't buy the first breakout of the tight channel. They wait for an extreme test. Once we get the extreme test and a double bottom and the second entry buy, bulls start buying that, looking for the day structure to complete. And so a possible test up to the top of the channel or the open of the day. Now, when traders are studying the rally, if it's weak, that makes a trading range or reversal more likely. So when there's overlap on the rally, when there's a lower slope than the initial rally, if it has a wedge shape, then traders will start looking for a major trend reversal, which usually leads to a trading range, but can lead to a full reversal. So here's a tight channel, first break, and we test the extreme, we get a second entry sell. So some traders will sell that, looking for a major trend reversal. Some will wait for the bear breakout through the moving average and then sell. So Al says that traders should only sell after a strong break and retest of the extreme with a good signal bar or a bear breakout in the bull case. So here we have a tight channel, strong breakout. Again, it's bought because it's the first breakout of a tight channel. And you can see here again that after the rally, bulls bought that failed bear microchannel. So that's a very common occurrence for scalpers. Once bulls show that they're still present, when we come back down to that break of the bear microchannel after a tight channel breakout, there are buyers there because bears are exiting their shorts and bulls are buying for a scalp knowing that there are going to be trap bears there. So advanced traders wait for the bulls to show up again, and then they buy that the area where the bears are going to be exiting. So that's a very common occurrence. But now in terms of studying the rally after the breakout, here we have strong leg up, pullback, and second leg up. So now we have a channel and a smaller, less steep slope than the initial rally. And so bears are going to be looking for a major trend reversal. There's no clear signal bar here for the sell unless you see this as the low to sell, which is reasonable. It's still above the moving average. But once we get that strong break through the moving average, so the transition back through the moving average, that increases the odds of a major trend reversal and at least a second leg down from that. So bears will start to sell. Here we have a tight channel, strong break above the moving average. Bulls look for a test of the extreme, and in this case, it looks like the bears are weak on the test of the extreme. It's turning into a bull flag. So bulls can buy with a stop order. If there's no great stop entry buy, on this day, I'm pretty sure Al marked above the 2 dojis, which is kind of tough of a buy for most traders. But then once you see the retransition back above the moving average, that ends up becoming an easier buy for a possible spiking channel or just a major trend reversal. So here is a slightly broader channel, break. Traders study the test of the extreme. in this case, Al bought above this bar, which is why I have these arrows here. Al bought above this bar because he was looking at the test of the extreme and he said it's weak. It's forming a wedge here at a lower major trend reversal. And so he bought this above this bar, and he said is a reasonable buy, looking for at least a trading range, possible major trend reversal. Now in this case, he got stopped out below this bull bar, but he bought again above this bull bar and held it. So I'm showing this to show that this is what traders are actually doing. This is what Al actually did on this day, that he sees the break, he's waiting for a test of the extreme, and he's looking for some kind of signal that we could get a major trend reversal. And sometimes you get stopped out, even after 30 years of experience. That's just part of the expectation, that it can happen. But the concept is that we have a reasonable expectation for a major trend reversal, and you take the next reasonable signal, and in this case, it worked out. So here's another example: break, retest of the extreme, then transition back above the moving average, strong breakout. That makes it more clear that we're in a possible major trend reversal, or at least get a second leg up from this rally. Here's the example I showed earlier. So we get a break below the moving average, test of the extreme. In this case, this is really tight, but it could be late in a structure. It's not clear here, but then once we get this bar, it becomes clear. Transition below the moving average, probably major trend reversal. And so that's a very common theme. Traders looking for higher probability. They may not enter with the stop entry buy with a signal bar, but they'll look for the strong breakout and then sell. So here again, spike in channel, break above the channel, break above the moving average, test the extreme. You can either buy the high 2 here, the second entry buy, or wait for the strong transition above the moving average and then buy. And here again, break above, higher low major trend reversal, transition above the moving average, and bulls start to look to buy. And one more time here, channel, break, test of the extreme, transition above moving average, at least a couple legs up. The last way that Al recommends you trade a breakout of a tight channel is look for a surprise breakout beyond the moving average, and then a good stop entry at the moving average. So you want to see it break kind of seamlessly through the moving average without having any pullbacks, and then pull back to the moving average with a stop entry buy. So this is common in tight channels in trading ranges, because tight channels in trading ranges often fail. So here, for example, you get a tight channel up here, but you're in a trading range, and this breaks straight down to the moving average. So it breaks to the moving average. There's a small pullback here, but nothing major. If you went to a 15-minute chart, it's just 4 bars down. And then you get a test of the moving average with a low 2 sell. So if it doesn't give you an opportunity to get a breakout, retest of the extreme, and then a sell, Al says wait for a really strong surprise breakout below the moving average, and then look for a pullback to hold at the moving average, and look for a stop entry sell or buy. So here's another example. We have a strong rally up. You'd expect a second leg or some kind of channel. Instead, we break strongly back down. So seamlessly back down, accelerates through the moving average. So traders will wait for a low 2 at the moving average. Here, the signal bar is not great. So some traders will sell during the breakout, but this is actually tough because it's not a clear signal bar. So here's another example. Spike, pullback, tight channel. This whole thing's in a tight channel. It's a wedge, but it's kind of tight. But then here we break strongly below the moving average, create a big gap between the moving average and the price action. Then we pull back to the moving average, and we get a wedge sell right here below this bear bar. So even though breaking above a tight bull channel and having an overshoot doesn't really lead to much downside, experienced traders and experienced scalpers will take it when the context is right. So they'll wait for an overshoot of a tight bull channel and then expect that will now break to the downside and test the bull trend line. And so when the situation's right, they'll wait for an overshoot of a tight bull channel and look for a second entry sell, or wait for selling pressure, expecting that will now at least test a conservative trend line. And so I highly recommend watching the webinar from this day, which is June 10th, 2019, and see how Al explains his thought process of what he did here in this situation. And then here's the opposite case. This is the example that Al gives in the book. We have 2 legs down, and we have an overshoot of this bear channel, the tight bear channel. So he says a lot of bulls will wait for that overshoot when we have prior buying pressure and buy above that, betting that will at least test the trend line and possibly break above it. More conservative bulls will wait for a break of the tight channel and then wait for a pullback to buy above. And it could be a higher low pullback, it could be a lower low pullback. But traders who are waiting for more information will wait for a breakout and then wait for a pullback to buy. So here's another example. We have 3 legs down. If you draw the trend line and the trend channel line, you see that we have an overshoot here. So we have an overshoot, we have a bigger bar, and then we have a bull signal bar. Late in this structure, we have buying pressure here. So this is probably going to be some kind of trading range day, a trending trading range day. We could test the open of the day. So there are many reasons why bulls will look for an overshoot and a buy. And this is a reasonable stop entry buy above this bull bar because there are 3 legs down and we have an overshoot in a channel late in a trend. Here's another example. We have a broad bear channel. And then when you broaden the channel out, we have an overshoot of that channel line. And then we have a tight channel into that, which gets a breakout, pullback, and then a buy. So when you have a tight channel, some traders will wait for the overshoot and a buy for higher probability. And that when the context is good, traders will wait for a breakout of the tight channel and then a small pullback and look to buy that. So it's a little bit more advanced because Al's usually recommending with tight channels that you wait for a large breakout, test of the extreme. This is kind of a smaller version of that, so you have to have a better read of the price action. But because here the context is in a broad bear channel and we've already overshot it, we're probably going to test the trend line. So there's a lot of reasons to be looking for a breakout pullback buy here. Now in this case, we talked about why this is a good sell because it's a strong break, tested the extreme in 2 legs. And now we have a tight channel here. So some traders might be seeing this as 2 large legs down for trend resumption. So they might be looking for a tight channel breakout pullback buy. But now we break out, but when we pull back, we don't get that buy. So traders who are waiting for the pullback buy don't get it, and we get trend resumption down instead. So this actually turned into a full major trend reversal. So we talked about breaks of tight channels and what to do as they get broader. So as they get broader, more traders will take profits at extremes, and more traders will look for major trend reversals at extremes. With broad channels, they act more like trading ranges, even though they're slope. So more traders will buy low and sell high. And with broad channels, the first break is usually already a major trend reversal. So with a tight channel, that's not the case. With a tight channel, the first break will usually fail. With broad channels, that first break of the trend line is often already a major trend reversal. So here we already have the first break above the moving average. This is the lower low test of the extreme. And then we break the trend line here, but we already have a major trend reversal. So because it's so broad, there's so much two-sided trading that first break is usually already a major trend reversal and traders will start buying it. Now it's also true that a broad channel is also acting like a trading range. And so sometimes it's already at the target. So the target for the channel is the top of the channel. And so if it's already at the target, sometimes it just becomes a larger trading range and breakout mode. So here, this was September 7th. We had a breakout, so spike, pullback, broad channel. And this broad channel broke, formed a double bottom bull flag, and then got breakout mode and trend resumption to the upside. So once the channel is broad, it doesn't take much for it to reach the target. So it often just becomes a larger trading range. But when the channel is broad, you'll have more traders selling high in a bull channel, betting that we're going to get a lot of two-sided trading. So more traders are trading counter trend during these broad channels. They're not necessarily trading the breakout of the broad channel. Here's another example. We talked about it. After the 2 pushes up and it holds here at the trend line, traders will start to sell the 3rd push up, betting that it increases the odds that we're going to break through the trend line. And now we get to the bottom of the channel. And once we get to the bottom of the channel, it's a larger trading range. And here we got a bounce here. So it just ended up going sideways and forming breakout mode. So broad channels are not necessarily meant to be sold after the breakout of the channel. But once you get 3 pushes up in a broad channel, it increases the likelihood that you'll get that eventual breakout from the trend line. Now, we talked about how channels can break from the trend line. So for a bull channel, we talked about what happens when you break below the bull channel through the bull trend line. But sometimes you can break above the bull channel, and that's what Al calls overshoots. So sometimes a channel will break out from the trend line, and that will usually be a climax. So it often fails within 5 bars, and it might sometimes be strong and reach a measured move target and then fail. So even if it's sharp, usually the breakout will fail eventually and come back into the channel and test the trend line. So tight channel overshoots usually don't lead to a high probability counter trend trade, and most traders should just wait. So here we have a tight channel, we have an overshoot, it comes back, tests the trend line, and then starts to rally again in that tight channel. There isn't really much room to trade, and most traders should not trade that. So here we have a breakout from a channel here. We have a spike in channel. We get an overshoot. In this case, it leads to a strong break, but even that strong break of the first tight channel shouldn't be sold. So there isn't really much to do in tight channel overshoots, except maybe wait for the breakout and then look for an extreme retest. Now, this is true for horizontal channels as well. So when you get an overshoot above a horizontal channel and that breakout fails, it usually comes back into the channel and then tests the extreme, the other extreme. So in this case, it tests the bottom of the channel, and it often breaks out below it. So you get a failed breakout above a tight trading range, it comes back into the horizontal channel, breaks below it, and then gets a measured move down. So the target for a successful breakout below the channel is a measured move of that channel. And you can see a lot of examples here in the book, in this chart in the book, with measured moves up and down from breakouts of horizontal channels. So here's the example we talked about earlier. We have an overshoot of this broad channel, probably going to test the trend line and often break through it. So here, once you get the breakout pullback and the second entry buy here, a lot of traders are waiting for a test of the trend line and possible break through it. So here's another example. We have a broad channel. We break through it, so overshoot, get a first entry buy, second entry buy, and now we're back in the channel on a second entry. And traders are going to expect at least a test of that trend line, and here we get it. This one's interesting because it has multiple interpretations and they actually both lead to the same outcome. So in this case, when you have these two swing lows, if you draw the trend channel line using swing lows and then drag it up to the 13 high here, so the two white lines, you get an overshoot here, but it may not be as credible because we don't actually have a second test. We have two up here, but we don't have evenly spaced tests of the trend line. So you're not really certain if that channel is active or being respected. But then if you use these two swing highs to draw the trend line and then drag it down and anchor it to this low, you get an overshoot of that as well. So that's the broadest interpretation of the channel, and that also gets an overshoot. So that increases the likelihood that we at least get to that red trend line. And in this case, we actually got to the white trend line as well. Another example here, broad channel, we overshoot it here, we get a second entry buy, so bulls buy that for a swing, or they wait for a strong break back into the channel and look to buy a pullback or look to buy the close, looking for a test of the trend line. So once we overshoot and fail, the odds are that we're going to test the trend line and possibly break through it. Here's the example Al has in the book. So we start to break through the bear channel. So bear breakout of a bear channel, probably a climax. We reach a measured move target here. And on the next day, we break strongly back into the channel. Once we do that, the odds are that we're going to test the trend line, which we do here on 19. Here's another example, bear channel, bear breakout of a bear channel. And so you look at right where the breakout happens, you look at the distance from the trend line to the trend channel line, you find a measured move, and that's usually the extent of it. A bear breakout of a bear channel will usually fail and get back into the channel, and then right here, we test the trend line with 2 bars left to go in the day. So here's another example. I showed this earlier. We're in a broader channel, but then here the bottom fails. We get 2 legs down into an overshoot second entry buy. So bulls will buy that for a swing, looking for a test of the channel, or they'll wait for higher probability, waiting for a strong breakout. Once we get these bars, it's more likely that we're going to get at least a second leg up and probably test the trend line. So one thing to be careful of here that Al mentions in a prior chapter is when you're looking for overshoots, it's important not to draw the shallowest trend channel line. So if you just keep drawing trend channel lines, you'll just keep seeing overshoots and assume that the trend's going to reverse or test the bottom of the trend line. So it's really important to let the channel progress, and it's best to look for overshoots late in a channel. So if you just have the first spike and then 2 legs down and you start to draw trend channel lines betting that they fail, you're more likely on the wrong side of the market and you'll just constantly be looking for reversals. So it's best to wait for a channel to establish itself and then look for overshoots of that channel. And that's why Al says most traders should not be looking for overshoots and looking to trade counter trend, because you fall into this trap of just seeing overshoots everywhere in strong bull trends. So it's only when it's a clear established channel and it's obvious that this is the channel that the market's respecting, and then you get an overshoot, that's when traders should start looking for counter trend trades, and mainly in very broad channels. So now with all these examples of climaxes and overshoots, it's also important to remember that 25% of the time, you will get a successful breakout of a channel. And that's highly dependent on context. So there are certain contexts that are more conducive to successful breakouts of channels. And usually that's in a trading range and when the higher time frame context is more supportive. So there are situations where you'll get a bear breakout of a bear channel, you'll reach a measured move target, and you'll get a second entry buy, and Al did buy above this. So the concept is sound, that you can buy it. but he managed it. And he said it didn't race up. We got a tail on this bar. And so he exited with a scalp. That is a very advanced level of trading that most traders should not do. So if you take it because it's an overshoot and a measured move down, then you might get stopped out or you might exit below a bear bar. You're not necessarily managing it during the trade, but it's always higher probability to wait for it to get back into the channel. And you can see that in this case, it didn't break back in the channel. It's actually just testing the trend channel line. So if you're looking for the swing buy, it's by the nature of it, it's going to be lower probability because it's lower risk. You're buying above a stop entry buy, but the concept is sound that you can look for it, but sometimes the breakout will be successful and you'll lose the trade. So an area where the breakout above a bull channel will be common is when you have a trading range or a potential bear flag that now breaks to the upside. In those kinds of situations, it's not a very long established channel. When the channel is very long and established, overshoots usually fail. But when it's early on in the game, sometimes trends start with small failed bull channels, and that's usually a small failed bear flag. So a bear flag fails, it rallies to the upside. A bull flag fails, it sells off to the downside. So when it happens early in a move, it's more likely to succeed, and that's common in trading ranges. So here we got a breakout above a bear flag, and that led to multiple legs up. But here again, we have a trading range. We have a potential wedge bear flag, parabolic wedge bear flag. It tries to break below it. Instead, it holds at the moving average and gets a strong break above it. Very common in trading ranges. Here, we have the higher time frame context right here. We have a spike and tight channel. We've mentioned this earlier, that we have a break above a tight channel. Usually that's still bear territory. So bears will still sell the first break of that tight channel. And so we're expecting sellers up here. And so now you have a bear channel bull flag in an overall bearish context. So the likelihood of this failing is higher than it would be if it was an established bear channel. This is a bull flag in a context where we're probably going to find sellers somewhere here. It may get one more push up for a major trend reversal. In this case, the bear channel failed and got a bear breakout, and so bears will start selling. So that is channels and channel breakouts and how to trade them. It was long, so I hope I didn't go too fast, and I hope it made sense, and I hope my explanations were clear. And as always, if you have a different interpretation of it or see it differently, please let me know. Happy to discuss. Hope it was helpful, and I'll see you in the next one.